And we are live.
Hey, before I can
Bacon,
even share the link.
I'll let you do the intro since you have been the one
Oh,
carrying the.
uh, I don't think we ever have an established intro. It's just welcome back to the show of Two Accountants, One Gap, where we talk about things accounting related, finance related, just random different topics under that broad umbrella. Welcome back, Andrew. You've been
We, we,
quite busy.
we can do that, or we can go, "Hey guys,
Oh, hey guys!
hey guys."
God,
Text.
God, thank you, Dex. That oh gosh, that's just awful. But
um.
yes, Andrew, good sir. The good people
So,
definitely came for you, I imagine.
the good decks. No. The people came for you. You gotta stay humble. Um. But so I want to talk about asset-backed securities. I went down this rabbit hole a bit in researching a company that I was looking to short. Um, it's and I just thought it's interesting. If you think asset-backed securities, I think the first thing people start to think of is CDOs, um, or mortgage-backed securities, which a mortgage-backed security, it's an asset-backed security of sorts. Um, but we can just kind of do a general breakdown of what an asset-backed security is, and then we'll get into an example and see how that looks. I'm
Mhm.
going to give you generally, you're not going to see a company performing well needing to go to asset-backed securities. We'll just
Why
say
would
that.
that be?
Yeah,
I
because
wonder why.
usually, and we'll get into it, but usually if you think about it, if you don't trust the actual operations of a business to back up the security and you're like instead going down to an asset that they hold, it might be indicative that um, you don't really have faith that this thing will continue as an operation for forever. So, asset-backed securities. I'm going to go to start with the Wikipedia of finance, um,
Investopedia?
Investopedia. Then we'll go down a little bit further.
Oh,
We'll do.
there we
There we
go.
go. And can I just get rid of this ad? I guess not. So, asset-backed security. Basically, you take some kind of asset. Maybe it's your customer receivables. Maybe it's your real estate. They have other ones in here. Um, they have CDOs, home equity, auto loan, ABSs, credit cards, student loans. So basically, an asset-backed receivable, and we'll just look at see if they have an actual definition. Uh, Thank you, Zeraturn, for the question. Um,
Yeah.
it's an inside joke. That was pretty good.
Oh, really?
Um,
I've been
yeah,
trying. I and failing.
yeah. So this is okay. I like this. So asset-backed securities allow their issuers to raise cash, which can be used for lending or other investment purposes.
Mhm.
Underlying assets of an ABS are often illiquid and can't be sold on their own. So pooling assets together and creating a financial instrument out of them, a process called securitization, allows the issuer to make illiquid assets marketable to investors and allows them to get shakier assets off the book, therefore alleviating their credit risk. Okay. So I have a very good example for this, but basically what this is saying is I am a company. I have an asset that I'm not really, it's not liquid. Um, I want maybe money now. Maybe I need money now because I have holes in operations or something in terms of cash flow. And so what I do is I take this asset and I basically, it's almost selling it off, but I take a loan against it. So a really common one, the most common one I see is receivables. Um, and Bacon not being a moderator.
I already have access to the manager or the channel
Yeah.
abilities, so
Yeah.
I don't need it.
I guess you could technically make yourself a mod, but
No need, no pressure. Anyways,
so um so basically they take the most common one I see is receivables. I mean, I'm sure Um, Mortgage-backed securities are really common too, but like when I'm looking at companies, especially like poor quality companies, I see this a lot in receivables. So, um, yeah. So, in summary, you're taking something like receivables. So, I am a company. I have credit card receivables. Maybe the collectability of them is questionable, anyways. I have low income, low credit score people. That's my group of asset,
Customer base.
or yeah, it's my customer base and group of receivables.
Yeah.
So then what I do is I do an asset-backed security. And asset-backed security there's 3 levels to it always. So you will always see within an asset-backed security an A tranche, a B tranche, and a C tranche. And so the A are the senior ones. So they should have, I would believe, a lower interest rate because they would therefore be less risky because they have the first right to get everything from the receivables. And then you have the B tranche and the C tranche that, um, they're junior to the A. So basically, what happens though, it's really interesting, the process. And I think I have the actual process of setting this up, I find so interesting because you would think it's like fairly straightforward, but because like I think what it is that these people when you securitize these, your company's at a point where like people are really worried about like bankruptcy potentially, or you just not having continuing operations, that they want to be sure they have the rights to these receivables. And so let me look up credit card ABS because I like the chart that it has on one of these websites. Give me a second. Makes it
Not a
really
problem. While you're looking, if you happen to enjoy the content, please do consider liking, commenting, subscribing, hitting the bell icon, and continuing to share this content to others by word of mouth. Please and thank you.
Oh, it's actually from the FDIC where I found it from. So here's the basic setup. What you do as a company is you set up a special purpose entity, or a
Mhm.
VIE. And so, like, yeah, this looks complicated as shit because it is. And I find this is the kind of stuff, like, I'm a nerd. I find it so interesting. So, what you do is this right here would be company A. This is the actual company, the operations. So, what they do then is they set up a VIE or SPE. And that SPE, then they put the assets that they're securitizing into. Because then, if you go under, not everyone has a claim on those assets, only the people who specifically had the loan against them. And so then what happens is here's the servicer. This is the trust issue. Trust issuer is, let me just make sure. So this is the bankrupt. Even here, it's like wholly owned bankruptcy or remote SPE. Like it makes it very clear. Like in case of bankruptcy, this is separate. So then this, I believe, is the VIE in which it's actually held. I think you like have a bankruptcy remote SPE, and then within that, it's a VIE. I think it's really confusing. Like I understand enough to be able to look at it on a balance sheet and be like, "That's what's happening," but not enough to like know the ins and outs of it. But I don't think you need to understand this,
Conceptually, we're not lawyers, so
right? And then, yeah, investor certificates purchased by investors. These investors, I believe, would be these are um, the people who are loaning, who like then get the receivables of collateral. And here's a seller's interest. So the other thing that you're always going to see with these, and I'm going to give you a very concrete example so we can like tie it all together, but I find it really interesting. The other thing that you're going to see is there's always another class of another tranche, we'll say, issued. And like the one I seen was like class R. In the class R, it's basically just the originator up here, the seller. It's how
mhm.
they retain interest in this VIE in the receivables, so that they can then have the collateral, the loan against it. So like these guys are securitizing, and I don't want to say selling, but taking a loan against receivables. They do that by setting up these two entities. Then there's investors, people that take out the mortgages or get the receivables, give you a mortgage. And then this is you right here. Super, super straightforward, I know. And then this is back to saying like the A, B, Class A, Class B, Class C. Here's the actual master trust. Here's all the holders collectively. And that's why you have like the A holders, the B holders, the C holders. And then here's you, the seller, and your interest with like the Class R shares. So since this is very confusing, I'm going to pull in a company, and I'm currently short this company. I'm considering of upping my position, but like just for full transparency, this is how I went down this rabbit hole. But a company called Cons Home Plus. It is a shitco. They are burning money. The hope is that they'll burn money less in the future. I don't know. So if you look here, we'll start at the balance sheet and then kind of work our way back. So you can see here on their balance sheet, customer account seat receivable net of allowance. And you see his parentheses. It includes VIE balances of 351,000 and 251,000 respectively, which is obviously referring to 2024 and 2023. And then same right here, long-term portion of customer accounts receivable. So then you go down here and you have long-term debt finance and lease obligations. It includes VIE balances of 571,000, 166 and 410, 790 respectively. So this is saying here's their long-term obligations. Here's their debt. 571,000 of that is secured by these accounts receivables. So if we then go down, I believe it's note I, but we'll find it. So and I do want to say, this entity is still responsible for paying the interest on this debt. It's not like the VIE somehow that gets passed off. So you don't escape the responsibility to still have, like, if you go to their statement of operations, interest expense, 81,000, you don't escape that. So just want to point that out. Okay, so let's go down to
when EBIT isn't even safe enough.
Dude, no, you can't use EBIT on this. Even EBITDA, you can't use either. Yeah. Oh, here's our customer account.
Yeah, for those that don't know, EBIT, earnings before interest and tax, and EBITDA, earnings before interest, tax, depreciation, and amortization.
So we're gonna keep going down. I'm just trying to find I should have had this prepared better, but that's okay.
We're just here for fun.
I always like seeing troubled debt restructurings as a part of a company. If I was long, that'd be wonderful. Okie doke, where are we? Okay, here's the financing debt lease application. Here's the asset-backed notes that they have. Wonderful, wonderful, wonderful.
Yep.
So essentially, and you can see, let me see if this makes sense. Yeah, so Class A, that's because they have the first, yep, this makes complete sense. Okay. Actually, no, this doesn't make sense. I would think this is...
Because contractual interest rates, those would stack up.
Contractual makes sense. Effective,
yeah, contractual does. Yeah, effective.
There's some funkiness we could play around with that, but the contractual makes sense at least. Okay.
Yeah.
So to illustrate a point, this company has asset-backed notes. If you go here, so you have the master trust. Here's collectively the holders. So you have, let's say, you see how they have different classes: 2021, 2022, 23, 24. So here's the 2024 notes. See 2024 Class A notes, and I don't know, their notes here. Then you have the Class B and you have the Class C. So look here's like their tranches, right? A, B, C. Now there's the seller's interest part. I have to see. So then they talk here about this. This is the special purpose entity on August 7th, because this is when probably they were preparing for these ones, the 2023.
Yep.
They made a newly formed special purpose entity that's owned indirectly by company the A issuer. So if we go back here,
Yep.
here's the issuer.
Mhm.
So that's the issuing entity. Here's the wholly owned remote bankruptcy SPC. Con Appliance is really an indirect wholly owned subsidiary of the company, and Con's Appliance is. So then it just goes through here about, JP Morgan, Deutsche Bank, Citizens JMP, Region Security. They purchased this for fixed rate notes, fixed asset. Okay. So then it says the 2023 A issuer also issued the asset-backed notes Class R Series 2023-A.
Yep.
And the Class R note does not have principal amount or interest rates and were transferred to the depositor on August 17th to satisfy the risk retention obligations of Con Appliances. So what that is saying is that is this right here, the seller's interest, where they still keep an interest in the entity because it's still their entity. It's still their related party entity. So that's how this works. This is like not a situation that you as a company want to be in. And also, I understand this is like not maybe the most interesting thing, but I feel like if you're actually looking for like investment ideas, this is really interesting. Like understand this and be able to look at companies and understand because you're looking at this company trying to understand how they're able to do this. And if you're trying to guess the bankruptcy, you got to guess what's the runway on basically shit that they can securitize and flip out, and like get more debt on. And I know that like interest rates have been going up, but I'll also say like the rate these effective interest rates are going isn't good. Hold on. Let me see if I can find. So one of the things I found really funny, by the way, and this is just something I want to point out, is like these guys were bragging in their earnings call that their credit spread has become tighter. And what a credit spread is, and I'll just show this right here. This is the spread between the rate that you as a company can issue debt and treasuries. So of a similar duration. So let's say they reported in May of 2020. April 2024. So right here.
Yep.
Right. So let's say just run there. 3.14 was the spread. You go back a year. What's the spread? Like, we'll say like it went down, what, 1.5%?
Thereabouts, seems like.
And these guys were bragging that their spread went down 1.5%. And so the spread hasn't actually changed effectively. Sorry, just want to go on a little tangent about that because I thought it really funny when you're looking at this stat and they're like, oh yeah, we're really glad that our spread's gone down. I'm like, how's your spread gone down? I looked, I was like, oh, it hasn't. Is Fuhat saying I'm yapping?
No. I think he's happy that.
Oh, is that what that means?
I said hi to him and Moxie.
Yeah. I thought it's like a yapping emoji.
No.
Oh, okay.
I doubt it. Yeah. Fuhat generally doesn't hassle you that way.
No. Dude, I'm wondering. Interesting. I mean, these effective interest rates here aren't terrible. I mean, compared to what else they're getting.
What it could have been.
Yeah. I mean, the actual. God darn, never happens. The actual. Because if you go look at their other debt that they have, so they have a revolving credit facility. Insurance income. I'm trying to find. They had the rates of their. The revolving credit facility is here.
Yep.
It seems like under the amendment, loans on the revolving credit, their interest rate option, plus a margin ranging from this. And I want to say it went up.
Probably.
So it's SOFR plus 2.5 to 3.25%.
Yeah. That's what I'm reading.
Yeah. And then they had another one that was like, oh, this is it. So then they bumped theirs to a 3 to 3.75% plus so far. So yeah, they're like, debt's expensive for them. And then they also had like a debt covenant with this right here. This one was like highway robbery. This is a recent one for 108 million.
Oh,
This
very nice.
4.8% floor plus a margin of 8%. So they're basically SOFR plus 8. Anyways, back to asset-backed securities. So, I mean, they all work in a similar way where if you, and I just want to put this out there, if you see a company actually going through and going to do this, now one, it's a bad look because the company's probably in a rough place where they're having to get debt against some asset that's usually core to their business. Like, think about it like this. This company, Cons, thinks that their receivables are so bad, they would rather take interest and get the money now at like a fairly high rate. Like we saw the effective rates on that is not cheap. This is not, if you're looking at effective interest rate of 13%, 12%, 12%, 15, 8, 7, 19, not cheap. They'd rather do that than actually work on waiting for the cash flow to come through. And so you're seeing interest expense go up. You're seeing operating cash flows go down. And so, and this is a company that caters to, low income, 600 credit score average individuals. So basically, if you see this, it's a giant red flag if you're thinking of going long. It may be a good green flag if you're thinking of going short. I'm not saying to go short, yada yada, terrible, whatever. But so that's kind of my thoughts on all of that. I also think these. Well, we can go into why I'm short these guys, but I don't think that's. I mean, we could, but they acquired this company Badcock, which I think is just gonna like absolutely screw
Horrible
them.
acquisition.
Oh, awful. They got paid to take it, basically. That's how
And,
toxic that asset is.
and you're saying they didn't get paid enough for taking it on?
No. And I mean, because it also comes with more debt. That's the thing. I think I found. Let me see. Yeah, there's a bunch of write-offs and stuff. This is very interesting. But I remember I looked up on this, like Badcock, and yeah, you have a bunch of these. And they talk about the interest related to Badcock. And one of the things, I think it was like 3.5 million of interest just attributable to them. And they've only, and so one of the things I have to check is if that's a 3-month period or just a 45-day period, because they acquired this company in the middle of December. So I would think this is a, I believe this would be a 45-day interest expense, which means like these guys also are going to bring in like an additional 28 million of interest. Yeah, I guess they don't give actual outlook, but it doesn't matter. So let's look. I just want to find the actual interest. Also, if we look up here, yeah, that provision for bad debts is going in a bad direction, guys. Like, as a percent of average portfolio balance, going from 11.4 to 15.5. Woof. Not good.
What could possibly go wrong, Andrew?
That's something you probably want to look at and see how that's going again.
Yeah, for any retailer, provision for bad debts.
Oh, for sure.
Yeah.
Yeah, when you get a bargain purchase gain at a company of 104 million and you bought them for 75 million, that it's a toxic asset. So, yeah, that's why it's funny. If you look at the investing cash from investing operations here,
Hmm.
but you have a 3.7 million gain because they didn't pay any cash for it, and they got the 3.7 million from uh, Badcock. Yeah, during the year ended, company recognized interest expense related to secure borrowings. The company had no secure borrowings during or for the year ended January. So I think this is saying the company is cons. So you have 3.5 million in 45 days, roughly, give or take. And so, if you annualize that, that's like a 28 million. You go 365 divided by 45, so 8.1 times 3.5. Yeah, you have like a 28 million interest expense. Anyways, they also do a fun thing of securing. They also secure their accounts receivable. They kind of were trying to actually sell the accounts. Like their account receivables are so bad, they don't just try to take a loan against them; they try to sell them, and no one would buy them. That's how bad theirs are. Um,
Not even the loan sharks.
no, not even loan sharks. Not even B. Riley wanted it. Um, so yeah, I
Sure.
mean, let's see, off balance sheet. This is all their debt. Um,
So when it comes to off-balance sheet liabilities, is that a problem, Andrew?
uh, definitely is if you have off balance sheet arrangements, but they don't have any, so I'm not worried about it.
Oh, okay.
Oof, this company is just. I mean, I could spend hours talking about this company and just like, hold on, let's look at this real quick. I haven't even done this look yet, but let's see. Here's their 2024. Okay. So here is their basically debt, right?
Yep.
Including estimated interest payments that are due, as of January 31st, 2024.
Hmm.
Here is that same thing for 2023. The only thing that didn't go up was the real estate operating lease expense.
Oh, well, small bonuses,
Yeah,
small
so you're
blessings.
closing your stores and taking on all this extra debt. Dude, someone get five in the chat and just be like, dude, they increased it by how is this even? Let's see, revolving credit facility that technically went down. Term loan. Is that okay, good to know. So that's why the B Riley one went down by 15 million. They had a tax refund. They applied to it. That's a term loan, I think, from B Riley.
Oh, very nice.
Like, am I crazy looking at this and just thinking this increase in debt is absolutely astounding? Their interest expense might be higher than I think, even. Because, like, and then if you look at, I'm sorry,
No, no,
guys, we're going,
don't
and this is
apologize.
this is asset backed securities because that's what these all are. So we'll say we're
Yeah,
on topic.
no.
So,
Between that and also people have asked for uh, like a recording of sorts of people doing due diligence, and they're getting to see it in real time, or at
and
least
so
a smidge of it.
here's 2022. You can see how much
Yep.
and real estate operating leasing is actually a lot lower. So I guess they did take on some
Hmm.
additional stores or something here. And then look how much it's jumped.
Yeah, that less than 1 year number sure has crept up as time has gone by. When long-term solvency
It's gone up a
stresses
lot too.
liquidity.
Is the 1 to 3 years, because that's where
Oh
you're
yeah.
taking out. So this is the payments. So this year, wait. So they have. This isn't including the Badcock debt, is it?
Oh. Well.
So, because if you look here, I don't see
Yep.
any secured borrowings, right?
Yeah, that is true.
So, if you go down here, now, yeah, sure, you can argue that like Badcock will also bring in extra revenue and everything, but you're just looking at how much debt these guys are in. Secured borrowing. That's not the term loan. The term loan's within this.
Hmm.
So you have. I'm actually trying to do the math on this. So if you back out these, because we don't care about these.
Being
Right?
generous.
Well, because like, okay, so you back out equipment, like who cares?
Yeah, yeah. It's marginal in this
Um,
scheme of things.
if you back out that,
Yeah.
whatever these like contractual commitments to buy inventory, I don't really care. You get 1404,730.
Are you saying it doesn't add up?
Does it not add up?
I don't know.
So, okay, so you have these class notes here.
Hmm.
Now, your revolving credit facility should just be in long-term debt, right?
I think
Because
so.
it's 1 to 3
Yeah,
years.
yeah. So some
So,
of it has to be parked there.
and your term loan has to be in there.
Chunk of it for sure. Yep, the long-term portion.
Oh, this is anticipating interest as well, I'm sure.
Oh, okay, okay. Yeah, yeah. That would be relevant.
So, but it still doesn't have the secure borrowing in here, which would
Yeah.
still. So I guess their argument is okay. So this is why, because their argument would be the customer receivables will be like that pays off the for that special arrangement with Badcock. But they still have to pay interest on it,
Hmm.
and that's not in here.
No.
Um, interesting. So I mean, it could be correct accounting. I'd have to look at how you do accounting on this, and potentially that's correct. So the issue I have is if we go here, like statement of operations, the operating income is going in like a terrible, terrible, terrible direction here. And I don't see it improving. If we look at, I was showing you this off stream or before the stream.
Yep.
Um, okay, so actually, I didn't show you this one. Let me see if I can find it. That's 2023. So this is delinquency on credit cards. This is a chart of credit card delinquencies.
Yep.
This is a bad chart if you're a cons. And so it's not getting better. Is it maybe starting to like smooth out? Potentially. But you don't want it to smooth out at this part where you're losing this much of a operating amount because of bad debts, basically. And even if you took this bad debt to zero at this point, you have become such a toxic asset. You can't even cut this to zero and have in 25 million operations, interest expense 81 million. You don't have enough to cover that anyways.
No.
At least you have a provision or a benefit for income taxes, I guess. I don't know. And if you go to even like cash from operations, if you go to statement of cash flows operations, you're negative 51 million last year. So, how much debt did they take out last year? Because what we're seeing, just so you understand, this is actually really interesting. And this makes me even more. So last year, at this time, they had 221 million that they were saying is going to be due in the next year that they have to pay, right?
Mm-hmm. Yes.
So, and most of it's just contractual commitments, but yeah, so this year they have 239 million. So it's going up by 20 million that they're anticipating. And and they're buying less furniture. Nice.
No. That just means they're being efficient.
Yeah, sure. Maybe they are. Well, they're closing stores. So they did that. Now, how much extra debt did they take out this year? They took out. Oops, I missed the balance sheet. There we are. So this is this year. Where's last year? So we go down here. So this is last year. And they had long-term debt 636. We'll just discount the secure borrowings because on the secure borrowings, you could just say that's due to Badcock, right?
Yeah, if we wanted to make that argument on behalf of Con.
Mm-hmm. So they went from 636 and 937 here. I'm not really going to worry about like operating lease liabilities, things like that. So, because what I'm seeing then is they took out an additional, let's see. So they took out an additional, at a minimum, 185 million of debt. Which obviously there's also interest expense on that. So this snowballs very quickly because then, they had to take this out because of their loss from operations and everything. Now, because what I'm trying to do is forecast, well, how much more debt are they going to need just to meet operations this year? Because it's going to be more than 185 million. Because obviously, we're assuming steady state, the business continues as it did last year. At that, then you'd have to take out the additional interest expense that this 85 million, and we saw it was roughly, we'll say like 11-12%. So you're looking at another like 210 million that you're going to have to take out of debt just to hit operations is what it looks like. And to pull on that because they have lines of credit and things like that, in their but this is like something as a company is just unsustainable. The other thing that we found that was funny, so we have this delinquency rate, right?
Yes.
So I showed you, I think, the Google Trends search.
Yes.
So there's a couple of things in Google Trends that probably isn't a good thing for this company. So we're going to start first by doing cons. Now, yeah, how many people look up cons? Not many, but I think the way it kind of, we're going to go. 2004 to present, you can kind of see a downtrend that's been happening since COVID. COVID, everyone was buying.
We are demonetized. Joke's on you, YouTube. We weren't even monetized to begin with.
I forgot you can't say that. What a stupid.
But
And
Yeah.
then here's Badcock, which is having the similar decline.
Yep.
And it looks like maybe it's stabilizing here. You don't want to be stabilizing here, though. You need to return to here to have a chance of living as a company. um, but this one I found particularly funny because the other thing that's they're having a big issue with is these people that they're writing to. Look at this. Look at this search term. Oh, it dipped during COVID to the lowest ever, which kind of ties to our savings rate, and everyone didn't have defaults. And look at
Mm.
this rise that we've been having. Not only back to normal, which was like at the 30 here, but actually above normal by about 50% to 50. This does not speak good for the overall consumer, but also doesn't, and obviously it's a Google trend chart. It doesn't mean anything by itself, but it doesn't speak good for especially Con's core consumer because they are the ones who are more credit constrained. They have the 600 credit score. I can also say, by the way, if we're going to talk about due diligence, I did go to the cons near me twice in the last week. I'm going to it tomorrow as well. It's dead. On average, you have 9 to 10 employees in there. And talking to them, they said its sales are down year over year. Like I said, hey, how are you guys feeling like this year versus last year? They said it feels like there's been less last year, but we haven't had a 4th of July sale yet, so maybe that'll help. And they told me Memorial Day this weekend's supposed to be really big for them. And I went there today, and there was, including me, when I first went in, including me, there were 6 customers and 9 employees, and then 3 people walked out and didn't buy anything. So then there was 3 and 9. Not a great ratio.
So you're saying a
Um,
business where you have more employees than customers sometimes.
well, in the idea for the store is they have they really push financing. Like, dude,
Yep.
the first thing they said to me when I got there was like, "Yo, we can finance." And if you go to their like store, like watch what happens when you first open it. It's like, well, here's 40% off, but like get pre-qual. So they have like all this get pre-qualified up to $10,000. Oh, by the way, this time of year is really good because Texas tax-free weekend. That's kind of cool.
Oh,
It's 48 months no interest. Like they push. And last time I loaded up, I'm surprised it's not doing it. Maybe they're going for the Memorial Day sale. But last time I went, I got it. It was just like finance should be like finance is a good word or something like that. Like you shouldn't be scared of the word finance. And you see here like financing is like the first on this. Pre-qualify now. Oh,
no,
credit card installment loan, lease to own.
you pre-qualify.
Yeah,
Congratulations.
hell yeah.
You, the viewer, you pre-qualify.
So you can go buy it and then default on it, and someone in the audience can do that research for us. So, anyways, the point is, I see a company that's really struggling to do anything from operations. You know, we can talk about the B. Riley integration. I think, by the way, I figured out what B. Riley's angle is on this.
Alrighty.
Let me do this.
Yeah, because for the viewers that don't know, what kickstarted all of this was me mentioning a bearish outlook on B. Riley and the greater extended universe. Uh,
Yes. So B. Riley Financial is how I came across these guys because B. Riley Financial is the one that's still in Badcock. That was the bargain purchase. What B. Riley got, which is another thing that's like awesome to know, is they got, if you go to their balance sheet here, is this the why? Oh, 20, there we go. Okay.
Yep.
Is if you go to financial statements and supplementary data, you go to the balance sheets, you're going to see they have mez equity. And we can talk about mez equity really quick.
Yeah.
Basically, mez equity, I mean, it's junior to debt, senior to common equity. It's essentially preferred.
Mhm.
I want to say that's correct. I think there's some, but yeah, it's basically preferred equity. So debt holders have a priority over you. Now, with this mezz equity that's all owned by B. Riley, they can, and they're voting on this, but one of two things will happen. Either it will become available to be instantly diluted to the equal number to 49.99% of the shares outstanding. So basically, they're going to be able to, in a moment, dilute this company 50%. So this company goes from having 24 million shares to 48, so actually diluted 100%. Go from 24 million shares to 48 million shares in the market overnight. If they don't do that, then it becomes preferred equity that is 8 to 14% interest. Neither is a good option. So, and also B. Riley is the one that gave them that $108 million loan that's like an insane amount of interest, like 13, 14%. So the question someone had is, why wouldn't B. Riley try to prop these guys up? Because B. Riley doesn't want them to go in there. B. Riley has preferred securities in them. B. Riley has debt with them. And the reason I think it is if you actually look, so do you know why B. Riley made money during COVID? Like,
Liquidation. They were they were really good at finding troubled retailers, taking
yeah,
their overstock closing inventory, and then just selling
yeah.
it.
So they did the liquidation for Bed Bath and Beyond and Buy
Hmm.
Baby. Um, B. Riley. What else did they do?
I want to say they did Toys R Us, but I could be wrong. And that may have been before this period, regardless.
Let me see. Yeah, I think they did have Toys R Us as well.
Yeah.
So I think that they are um, potentially getting into this because they'll be able to make money off of liquidating everything. Because, yeah, I mean, you might say, like, oh, they want to keep it alive. They can dilute the preferred securities and then hopefully get their debt back in a relatively quick manner. We'll see. The other big holder of this company, though, is the Stevens Group.
Hmm.
So the Stevens Group is these guys, and they're based out of Arkansas. And actually, like the founder Warren Stevens, is like massively rich, like 3.3 billion. So they have a lot of companies I've never heard of. But I'm not saying that there's anything wrong with them. I just they seem more energy, petroleum, turbines. I'm sure there's some fine businesses in here. No idea. Doesn't matter. So they work as an investment bank, private equity, all that stuff. So cons, they have had an investment with them since 1998, and they IPO'd them in 2003. So they actually took cons public back in 2003. Now, Stevens, this group,
Yes.
owns. I'm pulling up the ownership here on ticker. So Stevens Group owns 16.95% of the shares outstanding. But if you look down here, Warren Stevens owns 4.5%. Now, who's Warren Stevens? Warren Stevens is the founder of the Stevens Group. And if you notice, Warren is selling a shit ton of shares. Warren is getting out. So, what I think is happening is that the Stevens Group is going to hold as long as they can to help to give Warren liquidity to get out. That's my theory. It's really hard. Like, this is not a liquid asset, like a liquid stock.
Hmm.
So you'll see a lot of fluctuations up and down.
Yeah.
So they're trying to help him get out. I'm trying to remember. Norman Miller, I think, is another. Oops. I think he's he's a CEO. Yeah. And so he's also selling. The CEO is selling, which may or may not mean anything. Who knows? But but he's also sold off a good chunk of his, 5% doesn't necessarily mean anything by itself. The CFO also sold at the same time. I don't know. And then who was the other one that sold? I found another selling. So like, in insider transactions, I don't try to look too deep into them because, people sell for all kinds of reasons. Even the buying can be some kind. You have to get the right stuff because it could be like a 10.5B plan where you're a scheduled buyer.
Could be.
So give me a second as I pull this up here. I'm trying to see if I can find open market buys.
Yeah. That being said, though, if it's
this is
clustered and meaningful amounts and percentages, then maybe it's not as much noise as it is possible signal. And when fundamentals are this poor, you know,
Yeah, so I didn't remember who Douglas Martin is because he bought, and I don't know if he is anyone. So he is Senior Managing Director, Stevens. So he's been Stevens Group as well. So Stevens Group is like all over this. So I think like you got Stevens Investment Holdings, Warren A. Stevens Trust, Warren Stevens. So collectively they own 25%. They were the Stevens Trust was the one that actually processed and was the bank to do the M&A transaction for Badcock. Let me just do some math because you'll see something that's really cool here in a second. Because you might be like, man, do they really want to take the wash here and like lose all this money? Because they wouldn't lose it all, right? Because they're selling out. But so you got that plus Harriet. So, you got 23 million here and you're like, oh man, that's a lot. Until you realize that they got like paid that much just to do the Badcock transaction. So if you go to the professional fees here, 18,372,000. And they said they're going to incur more in the first quarter. So yeah, we recognize 18.4 million in professional fees related to corporate transactions, primarily related to the acquisition of Badcock. So Stevens is still making their money on this investment. I believe they gave guidance that they would. I think they would have more. I think they said they would have more. More fees in Q1. So I think the Stevens Group is actually going to be more than whole on this. And they're going to, I think, be selling off some shares. We'll see. Maybe there's something here. Maybe Douglas Martin's buying it for some reason other than like maybe he got a cheap price to buy in it on. It through like being the bank to do the transaction. Who knows? So yeah. So basically, like I'm trying to go through and see like who's the big holders, how are they going to prop this up, or how would they not prop this up? But I see these guys selling. I don't see. I don't see that this company either surviving or definitely not thriving. So we'll see what happens, and like, yeah, we'll just have to see what happens
in real time.
Yeah, as we go through it, I'm just going through post insider sales to see what's going on. But so that, I mean, that's, I don't know if people have been. Can we buy Stevens Group? I don't know if Stevens Group.
It's not publicly traded, at least not that I've seen.
The weird thing too about Stevens Group is they stopped coverage on cons recent, like in August or September.
Oh, I wonder why.
Yeah, because obviously as an investment bank you do sell side coverage. They stopped their coverage on it. I found the analyst that was doing the coverage.
Oh, nice person.
I don't think I had an opinion. Yeah, Stevens and Co. reiterates con equal weight. Um,
Trying to hold the company line.
I like went down through it and found the analyst, but like I couldn't find the actual report. But like it doesn't matter because that was from August of 2023, right? But I mean, at the end of the day, they had. Are we in? I have a bunch of these open. We have a weakening consumer.
Yep.
And the weakening consumer is having. We're seeing rising credit card delinquencies, which will influence their bad debt expense. We have them taking on what I think is a toxic asset. They are bleeding money for operations, and to fill that hole, they're taking on more and more debt, which is bringing more and more interest. It's like there's like the Ramsey debt snowball. It's like this, but in reverse. Um, and so as you take on more debt, you have more interest expense. You have more interest expense, and you take on more debt to cover the holes. And something is going to give. And then you have the also added optionality of B. Riley just saying, hey, we're going to dilute you because we need money because B. Riley is massively stressed too. B. Riley sold 50 million of public equities in the last quarter and still somehow lost 40 million cash quarter over quarter. So like they're struggling too, and they're going to need liquidity soon. So I see a lot of different things happening. I can see potential additional selling pressure from the Stevens Group. I mean, if you look, insider transactions are a massive net negative. This Natella Capital Management LLC, I really need to do research on them and figure out who they are. Because they bought a lot of cons.
Think we'll be able to find that info?
They have a
I don't have.
13F. They're a long short fund.
Oh, okay. All right. Because
Interesting.
I do not have a Bloomberg terminal, sadly.
So they got 2.2 billion, 2.3 billion AUM. Oh man, they are contra Druck. They have their biggest holdings an IWM put.
Wow.
Quarter first owned Q4 2011. So they always have a put on IWM, and it's probably how they maintain net neutral. Okay, that makes sense. XBI put.
Okay.
So why did they buy Con? If you have a 2.8 or 2.3 billion dollar portfolio and you bought,
You said they're long short, not activist, yeah.
yeah, I don't think
So
they're
that
an activist.
yeah, and
But
I don't see why any activist in their right mind would want to.
I mean, that's the I mean, it's like a 0.2% position for them. I don't know. Might not matter. Oh no, right here. There's only 0.58% has here. But I would be curious. I think I tried to look up and like you can't really find much on them in terms of like public information. Let's see. But it could be that they have a call on Peloton. Man, these guys are interesting. And they're getting smacked right now unless they got rid of that Peloton call. Because it like went up for a little bit and then went back down. Here's con. No, yeah. See here it says point. That was closer, 0.34%.
Yep.
They just started buying it too. Huh, interesting. They're seeing something. But they're the only ones. But I wonder what.
What could they possibly see to justify this being like? Granted, it is a minuscule percentage, but even any percentage.
They're also buying Alt G. This is interesting now. B. Riley selling
G.
Alt G.
Oh, what did they lose a bet to someone in B Riley? Got to be their exit liquidity.
I don't think so. I think it could just be a coincidence. They own Riley. Very minuscule amount, though.
Mm-hmm. What would you say is the best aggregator when it comes to 13Fs?
I like Whale Wisdom.
Okay.
They have Dead on Par. Interesting. These guys might be really nimble. Like they might buy and sell a lot of stuff. Let's see. So they must been they were probably the volume that was moving Con up a lot to get in. I mean, I gotta think.
But why? It's fine though. Like that minuscule of a percentage though of their port.
I mean, yeah. So turnover percentage 32%. I think that means that and that's a quarterly turnover percentage. So maybe it doesn't mean anything. Who knows? We'll have to wait and see. Yeah, see, like they're long SNLOS. So maybe they wanted to go short someone else. Who else would they go short in that space? Can't really tell. We're spending too much time on this. Doesn't matter.
Yeah.
But maybe they're buying commons as a hedge.
It would have to be a hedge to something, but to what? I'm not sure.
It seemed. I mean, I gotta think they're just long. It seems very unlikely to me, but like, who knows? I mean, I'm not gonna be. I want to find out more about who this company is, because what I want to see is, dude, 11 assets. That's pretty crazy. 11 clients with 2.3 billion. They don't even say who runs it. Wilmot B. Harkey.
Thanks, Guru Focus.
Okay, that doesn't make any sense. Let's look at the other dude. Also, Guru Focus always like jacks my computer. I never go on there.
Yeah, it does that to mine as well.
Yeah. I think I lost it, but yeah. So, anyways, asset-backed securities. It probably means it's not a great company. I don't see the long look. The long thesis is this: consumer recovers, and we're at about so. They could be going long saying we think the consumer has bottomed, and we think credit card defaults have bottomed, and going from there. Do I agree with that? No. I think it'll maybe flatline, if not continue to go up. I don't think we're at that point. Now, they could also, I'm kind of walking through this in my head. They could say, well, election year, they're going to try to give some stimulus to the lower income somehow to allow them to hit these. I think that's a stretch, but I'm trying to go through this. But yeah, so I'll be watching for when Cons actually does their report. And what I care to see is what's their delinquency rate? What's the interest look like? Did they manage to hit operating positive cash flow? More importantly, did they not? Because this is normally their only quarter. And let me show you this. If you go to ticker, oh, and I actually want to look at something else, so we can pull it up here. Just trying to. Okay, so if we go to Com, one of the things I wanted to look at was this a company that was dying and then got saved by COVID? And if so, I'm going to kick myself for not trying to look into this earlier. Really, this is probably a good theme, is to look at companies like this that are levered to lower income individuals financing. Dave is that play, but Dave is more going long because they're trying to solve that, and they're not really taking on credit risk.
Yeah, they're on the sweet or the smart end of that side.
Yeah.
Yeah, whereas this, you're on the wrong end.
Okay, so let's look here. So they were struggling. See, they were starting to struggle, I think. Like they had been struggling, it looks like.
Mm-hmm.
See, this is that cute. This is the quarter where I say normally that's where they make money.
Yep.
Good. And then not great. Pop back up. That's always the top for them of that year. But then they had COVID, and COVID really bumped them up. Right?
Yeah.
And now they're really struggling, look at that, especially last.
I have another macro detail.
What's that?
If there aren't as much single family home, not so much single family home movement, or any sort of like buying and selling there, then there's also probably a lot less jump balls, so to speak, for them to get those. Because I would imagine if you're buying and or selling anything on that end, you're probably going to be in the market for furniture.
No, you're right. And hold on, let me do this, because if we go to the income statement, so here's their EBIT excluding unusual items. It's getting worse and worse. Now, to be fair, well, this was the first COVID quarter. Is that why that was like that? Probably.
Yeah.
Yeah.
Because that's 20. Yeah, 2020.
I mean, okay, and so what we can do? Let's do this. Let's overlay this with. Where are I? I was going to overlay this with interest expense. I was interested. That's not right. Aggregate data better, please. Let me see if I can find interest expense.
I thought you had it.
Well, that said interest expense, but it's not right. It's saying, look at that.
Yeah, that doesn't line up at all.
Maybe my aggregator's not working. Damn it.
Yeah.
It's gonna have a nice visual. We can look at ratios too. These are gonna be some fun ratios. Okay. Asset turnover. That's bad, right?
Decreasing asset turnover? Yeah. You would like a healthy number, especially not one that's decreasing. Because inventory turnover is my favorite.
Fixed asset turnover is going down.
Yeah.
Receivables turnover. I don't even know how you look at this, because this is like they don't really, they sell it all away.
Yeah, yeah,
So this
yeah,
is your
I think
favorite right here, inventory
yeah,
turnover?
this is my favorite. And well,
It's on a
we see fluctuations, but it's you.
trending down.
Yeah, yeah, you definitely would like
And
this number higher to burn through some inventory.
and if you look at this, they were trending down and COVID kind of saved them. Like, look, over here,
Yep.
it's trending down, trending down, trending down slowly, and then you hit like this, and then COVID bumps it back up, and
Hmm.
now it's trending down to like I want to say back to the true trend.
Yeah.
In fact, it'd probably be lower. Working capital turnover. Once again, in fact, it was worse over here, but and then where's short-term liquidity? I'm assuming this is getting worse.
Oh yeah. No, it has to. There's
Yeah,
no way.
right. And
Yeah, you use the current on that one.
ooh,
Yeah.
cash conversion cycle.
Alrighty. What is the cash conversion cycle, and why does this matter?
So this is how long it takes you to like basically buy your inventory and turn it into cash.
Yep.
And so what are they having to do to fund this is take out debt. In fact, I think this does it give the formula here?
Yeah,
Yeah.
it does, but it does. Ticker
Yeah.
always does it in an ugly way.
Yeah. So basically think about it like the time it takes me to buy my inventory,
Hmm.
sell it, and
Hmm.
then get the person who I sold it to pay me. So this once again, it was trending up, trending up, trending up.
Stimmy
COVID
check
comes,
season.
knocks it down, and then
Yep.
it goes back up to trending up again.
Yep.
What is the Fabio has that what's the name of that one? It's not on here. It's the one thing where like it's a pretty simple formula, but if you like 90% of companies that have a score.
Altman Z.
Okay. So let's look
Yeah,
at
the
the
Altman Z
Altman
score.
Z. Can I just do a
Yeah.
calculator? You think that'll work?
Maybe.
Let's
Hopefully.
okay. Does this look
It.
right?
Uh. Sure. That's weird though. Like I. Hold on. Let me. Because the formula. Yeah. It is. It
That's
is.
right.
It is.
Okay.
Yeah, it's right.
So can I just pull anything from this? You think that should be a good enough aggregator? Let's see. So we want net sales, and this is for the last year.
Sure. I think so. Yeah. Yeah. They got the right one. Uh.
So last year, it's annual.
Yeah. We can go. Yeah, we'll go with that.
Okay. So I got
Double check.
978. I'm going to double check off of the SEC filing, make sure this is correct. And just so you know, Altman
Yeah.
Z score is it's not, I don't feel like I hear it talked about that much. In fact, I think the first time I heard it was from Fabio, but doesn't it have like a 90% predict or 95% prediction or capability of predicting if a company's going to go bankrupt?
It's pretty darn good. Like I I think like the only glaring big name that it said would go under but didn't go under was like AMD.
Yeah.
Yeah. So like generally speaking, pretty good formula.
And they want EBIT, which would be EBT, right? That's EBIT.
Yep.
Almost.
Yeah, and it is annual because you would pull it from the 10K.
So we want total assets. And I'm just um, let's see. Total assets 2444042. Total liabilities 1946544. Retained earnings 463316. Working capital. I don't want to do this math myself. Please say we have working cap. What's working capital is cash, receivables, inventory, prepaids.
Yeah.
It's current assets, basically,
Yeah.
right?
Yep. Yeah. Current assets and current liabilities. Or shoot, did I screw that up?
We'll find out. Luckily,
Yeah.
Google's here. Yeah, it's current assets minus current liabilities. Yeah.
Yeah.
So they have, let's see, total current assets.
Okay, so on the Almond
124.
C uh, percentages, it has fluctuated somewhat over the years, but as far as the success rate, and it hasn't been applied in an academic paper that I'm aware of to every single company out there. But with a respectable sample size over the years,
So,
it's done pretty good.
so market value of equity. That's just me taking the market cap, right?
I want to say so. Let me. Yeah.
Let's see. Let's do this. So now I have to go back and.
Market value of equity. It might be market cap divided by total liabilities, but
Oh, I have to minus.
let me double check though. Yeah. It's usually market value. Market cap divided by total liabilities for that. What gets
Yeah,
multiplied by 0.6?
I might have messed this up, but
Oh, I mean,
because I
like if
think I
it's just market value of market cap, then it probably will be fine. It'll probably like divided by total
no, I just have to
liabilities.
add EBIT is a negative. Let me just get the EBIT here. I just have to redo it because I was like converting some stuff from
hmm
like some are in thousands, some aren't. So I'm just let's see. Like I'm assuming total assets is 2.4 billion. So we want just another one like that, right?
Yeah. Yep. And market value of equity is just market cap because it'll probably do the conversion on once the calculate button's hit.
Is that right? 1.2 billion in sales. I think I did this right. Question mark. We'll see.
Yeah. Let's fire up the calculator.
I don't think that's right.
Oh yeah. That is
I'm gonna have to
yeah.
do it. How to calculate? Yeah.
Ladies and
So,
gentlemen, this is why you don't do public math.
so net sales
you know.
1.23 billion.
Could it be that the aggregator is screwing us a little bit
I'm going off
with
the 10K.
overstating assets? Because
I'm on. I'm
oh,
on the
okay, never mind.
10K.
Whoops. I was tabbed away to try to attempt to give support. Um. hmm. Well, did you want to try it with an Excel spreadsheet?
So it says Altman Z score is measured on the basis of 5 different ratios.
Mhm. Or could it be that there was a negative integer and it screws everything up?
Let's see if we just do 0 here. What happens?
Yeah.
No.
Nope. Still big number. Yeah. Still big number.
Maybe they have no problem and they will be fine. I'm going to try one other one, see if I can get this.
Okay. It
Okay,
has
we're going
a
to try this
funky
one more time.
layout.
I don't know how I'm feeling about this one.
does not inspire confidence. But
We're gonna try this one.
no,
Yeah, I'm not hitting the download link. Sorry. Oh well. But
yeah,
no, we'll have to do the math and see like what the ultimate Z-score comes out for it. But anyways,
yeah. Worst case scenario, it's something for me to do with negative 2A 1G segment.
I want to do that. I really feel like this company's got so much going against it.
No, it
Um,
does.
and
It's
in the fundamentals of it deteriorating, and there's like vultures circling around it. You have like Riley like ready to just like either start taking interest payments or diluting the shit
diluting.
out of you.
Yeah,
Stevens Group, I mean Warren Stevens, the
so many of the what was it? Management also not doing you any favors.
mhm. Well, I mean the CFO. We didn't even talk about this. He resigned just after a year after the company's president and CEO also resigned. CFO George Becker submitted his voluntary resignation to the company on November 13th. This is probably when they were looking to get Badcock. So like he just resigned. I mean, nothing is good. Like, and I mean, and it's not like I feel like you're getting him way. So like, here's the price of the stock in the day. You're actually getting into like potentially short it higher than when like before the CFO CEO resigned. You know, CEO resigned a while back, so maybe below him, but the CFO resigned. I think this deal is toxic waste that you're going to get dumped on you. We can talk about Badcock really quickly for a second because,
Yeah, yeah.
can I pull up?
We're a little out of
So
order as far as like talking
yeah,
about con, but
so let me just talk about yeah. So FRG, which is related to oh, this guy's actually really interesting. Like he's like just writes. I like fun. He's like writes retail like home furnishings industry news, but he's
mhm,
pretty good. Uh, um, believe it or not. Uh, so let me see if like he even like is saying like it's B Riley's made connections to Con FRG. Do. Like he goes into all this, and he even like uh, he's pretty good. I mean, he's got like a million ads in here, but so FRG acquired, and this is actually talking about they acquired Badcock in 2021 at a for $580 million, and they got on this and I want to see if it mentions it in here. They had a bargain purchase gain of like 100 and something million on this. They then turn around 2 years later and sell it for 75 million at a bargain at a sale for a loss or a bargain. It was a bargain gain for Con of 104 million.
yep.
So, and I looked at what basically FRG did. They sold all the real estate they had. They loaned out all the receivables and took debt against it. They just gutted this thing. And it was funny because like I listened to some of FRG's calls. So I went back and listened to their calls, and they were like frustrated. They're like, yeah, like we're trying to get someone else to take these receivables. No one wants them because they're just so bad, basically. So I think I'm gonna up my short on this.
Well, at the time of recording,
By the
it
way,
is Memorial Day weekend,
by
so
the
it can't
way,
be done
yeah.
today. Yeah.
By the way, the Riley Bulls are a little upset right now. I don't know if I showed you this. So you know
No,
there's
I don't
there's
think
a
so.
Reddit Riley stock page,
Oh yeah.
and they're like a little annoyed because there's becoming more
Oh,
and more shares available to short, which means that it's
yep.
not as shorted as it was. And like people are like the shorts returns of borrowed shares, and like people are like really like what the fuck? Like they're really dude, imagine unironically referencing a Benzinga article. And but they're saying yeah, the short interest dropped a lot actually on Riley, which makes sense because of the pop that it had after the 10K, right? I mean, like, no shit. Um, but let's see, they had a daily discussion thread. And so here's like the short interest report. And yeah, so like look at the drop in short interest here. Like I don't get, oh, this is just saying the average, but you know, you went from like 12.2 million in end of March to 8.2 million now. So it doesn't really mean a lot, except that the squeeze isn't there and these people are retarded. So um,
When the big hope is short squeeze and insiders aren't helping you out.
but, yeah. But like, so to summarize though, my thoughts on this are look out for them having positive, like, let me just say, if they don't have positive operating cash flow this quarter, they're done. They're cooked. Short them. Go. I'm not going to say anything crazy, but they're done.
This
Don't
thing
go
is going to
long.
zero.
Yeah. But like you have to see how like all of their core metrics are just getting worse and worse and worse. Their same source sales are going down. Their rate of bad debt is going up. Their everything's going bad, and I don't see it getting better. And even if it stabilizes, stabilizing here is
Not good
terrible.
enough. Yeah.
It's unsustainable. And your debt that you're increasingly taking out is becoming more, it's snowballing as the interest expense piles and piles and piles up. And you're running out of AR to securitize. One of the things I noticed was they went from securitizing 30% to 80% of their AR year over year. You're taking on a toxic asset and you made a deal with the devil, which is B. Riley, who is going to short you, or not short you, dilute you, or have you pay interest expense to them. Like, and B. Riley is going to be continually running into liquidity issues because they're a company that's struggling too. So I don't see you getting out of this alive. And I don't think the Stevens group is going to be holding.
No.
I think they're going to try to get as much as they can.
Yeah, like the writing's on the wall. Words out. I mean, like we can even see it with the share price for whatever that's worth.
Let's see what happened to this guy.
Just wondering how they'll reverse split or when they reverse split. Okay, moved on to greener pastures.
Good for him.
Hey, that actually that person is person who went through the accounting side to become a CFO.
Mm-hmm. Resigned from position. He says resignation does not resolve any dispute, discredit the company, including related to its kind of practice. Also, since April, so they brought a guy completely new in. Yeah, so.
Alrighty. So, out of curiosity, when it comes to envisioning things playing out, um, if or when, realistically, the accounts receivables that are in under that VIE go bust, how much more ugly does this company end up looking? Like, what can we
Well,
expect on the financials?
as the credit losses and bad debt losses continue to go up,
Hmm.
you have debt
Yep.
securitized by an asset.
Yep.
The asset goes down in value.
Hmm.
So now you're going to have to take more of your receivables and securitize those, or find a way, or you have to pay down the debt. You're having it. I mean, like, not all the receivables are toxic, but a 15.5% bad debt write off is not good. And so you're going to run into this issue where something's going to crack, where eventually the I don't know if the people who are taking or giving the mortgage are just going to say, give us the receivables and we'll try to collect them ourselves, or they're going to try, because they can only go after those receivables. That's the only asset they can go after.
Yeah.
And so they may be happy to just say, we're going to liquidate this now, or find, take it. But really, what happens that's going to become scary is when they run out of receivables to securitize, which is one of the reasons I think they're going after Badcock. It's because they'll have more secure receivables to securitize. But that's a very temporary solution to a company. By the way, dude, when you start to get the Badcock numbers on this, those ratios are going to get worse and worse and worse. And so your inventory, I'm convinced
Oh yeah.
you're going to see all those ratios get worse. So I don't see this going well. I'll say that much. And now you guys have seen a small insight into the 30 plus 40 plus hours I've spent in the last week, like a maniac going
I
through this.
I want to formally apologize to you and to the viewers that don't like any sort of bearish or possible short theses, because I feel like the B Riley black hole just like sucked in so much due diligence time.
Yeah, but I think it's going to make me money. So I'm okay
Yeah,
with
yeah.
it.
So is this fair?
Yeah. So
Um,
I'm okay with it. I think that it's going to make me money. And then the good thing, too, is as you see that go down, then you can start to see the beginning of pieces falling for B. Riley and start to maybe look at getting into that, too.
yeah.
So.
Alrighty. Well, thank you, Andrew. What type of future content you thinking we could hint to the viewers, as far as collaborative efforts goes?
Do you want to get crazy and start looking into joint venture accounting?
Oh, that would be interesting. That I know at least one person would be incredibly happy
Yeah.
with that. Hello, Marquise. Um, yeah, so that would be incredibly crazy. That'd be really fun. I'll try and collaborate with you behind the scenes, as far as being able to hold up my end of the conversation. Um, from a negative 2A 1G perspective, someone referenced that it would be cool if I interviewed some people. So maybe I'll see if I can make that happen. But realistically, I'll probably have to do some solo content. Maybe the Altman Z score.
Yeah, we
I'll
should
make a
meet.
oh yeah
We
I'll
will
make
fix the Altman Z. I think the Altman Z score would be really cool to go through. It's
Mhm.
not talked about that much, and I think it's kind of interesting.
Yeah. So I'll make a cringeworthy Google Sheets document and share share me working through that, plotting through that with the viewing public. So there you go. There you go. You got one solid thing for sure. And well, no, two solid things for sure with some other vague things and going forward. And yes, new haircut, uh, fade. It was long overdue.
Oh, I noticed
So
that. I was like, yeah,
yeah.
it looks good.
So yeah. Thank you all for watching, spending your time with us. Andrew, you got any words for our viewing public?
If your company is making VIEs and securitizing debt, please reconsider your long position. And if your long position is just like short squeeze, please Go by VOO, VT, VTI, and don't ever touch an equity again.
Just go passive.
Yes.
Alrighty, I think that's a great note to end it on. So thank you all for stopping by, and we'll see you on the next one. I'll click it.